The Rebel Capitalist Show.
So what we have now, and I've given this a lot of thought, and I've heard you say that before, the commercial banks are responsible for creating about 97% of the, we'll call it dollars or euros, basically the currency units that are on the balance sheet of non-bank entities in the real economy. That's kind of how I describe it. But now what we have is the government here in the United States running, let's say, a $4 to $5 trillion deficit. And a lot of those bonds end up on the balance sheet of the central bank, the Fed, which, to your point, doesn't take money or dollars out of the system to buy those bonds. They just create new bank reserves that are denominated in dollars. So my point is, if the Fed is monetizing the debt, when those checks go out of the TGA and people deposit those create new deposits or dollar-denominated liabilities in the commercial banking system. So is that money creation?
Yes, it is. It is, exactly. So that is a different kind of QE, and there's a big difference. And the difference, I mean, I always measure credit creation of the banking system and the central bank, and use that in my Global Liquidity Watch report to analyze and forecast equity, bond, and FX markets in 38 countries. And last year was just amazing. I mean, everything in most countries, they were all doing the same thing. So you see the degree of coordination, well, we saw that with the so-called COVID policies as well, is quite extraordinary. And they'd all switched the QE. So the big difference to QE in 2008 and 2020 was that they'd all switched to now aggressively expanding bank credit creation, so that, you know, since May, June last year, I've been warning of the inflationary effect this is going to have. It was inevitable. So it is a different policy, and the goal has been to really now boost credit creation, boost spending, and push up prices. Of course, the question is, how long is this going to last, and where will this end? Initially, I was thinking, well, I mean, if they kept going at that extraordinary pace, then I would have
said, spending is what you're referring to, the government deficit spending? You're referring to the government?
I am talking about bank credit creation. Bank credit creation. That is, so essentially what happens is the central bank implemented QE in the form of forcing the banks to expand credit creation
through the PPP loans.
Well, that's one way, the guarantees, government guarantees, and exactly, but also by purchasing, essentially by forcing the banks to expand the money creation and create new deposits in the banking system. The central bank can do that, and that's what they did. Whereas they didn't do that at all in 2008. And of course, the result, you know, is increased spending, increased demand, and inflation. And the increase was so extraordinary that had that continued at that pace, then we would have talked about hyperinflation, but we're not there. Fortunately, they reduced this pace drastically. Although this hyperinflation scenario, I don't think is completely off the table.
Yeah.
Inflation is now out as an issue, and I think will stay with us. But it is a policy variable. It now depends on what they're going to do next. So one has to watch this very carefully. It's certainly one of the options, because we have all this debt, this national debt in so many countries, and high inflation is one way of just getting rid of that, and also ushering in a reset in the financial system. And of course, you know, the great reset is in everyone's mouth, and is one of the things that certainly certain players are aiming for on a global scale, with a new monetary system centered on currencies that are not really currencies, but are really control tools.
Yeah, like
surveillance and control tools, the so-called, they call it
digital SDR.
CBDCs. SDRs, or central bank digital currencies, which are all misnomers really, because you know, when you talk about CBD, central bank digital currencies, CBDCs, then it suggests like it's something new. But of course, we've had BDCs, bank digital currencies, for decades. That's the money we're using, is actually bank digital currency.
Sure.
So really what's happening is central banks, which are bank regulators, are now saying that, well, they're not saying it, that what they're preparing to do is they're about to step into the arena, despite being bank regulators. They now want to compete against the banks,
right,
by offering retail accounts to the public.
That's
this is quite extraordinary, quite extraordinary. And of course, to hide this, they call it something geeky, like, you know, central bank digital currencies.
Yeah, it's basically all the entities in the private sector, the individuals and the businesses have an account now with the Fed. So the Fed can turn those bank reserves in a legal tender, or the people can actually spend bank reserves in the real economy, where right now there's that transfer mechanism of the commercial banks. I want to go back just so I'm clear here. Let's just assume for a moment that commercial bank credit expansion was flat. And let's say the government came out and spent $1 trillion. So in order to get the money in the TGA, which is the liability of the Fed, they had to sell those bonds. Those bonds were not sold to the general public. So the dollars did not come out of the private sector to begin with. Let's just assume that those bonds were sold directly to the Federal Reserve. So those go onto the asset side of the Federal Reserve's balance sheet. They create the bank reserves out of nothing. That's a liability that goes into the TGA. And then let's say Janet Yellen takes that $1 trillion and sends out checks to, let's say, stimulus checks to individuals. They deposit them into Wells Fargo, Bank of America, Chase. So now the banking system has $1 trillion in additional dollar-denominated liabilities. And then the offsetting asset would be the TGA, or the Fed really, transferring that trillion in bank reserves from the TGA onto the reserve accounts that Wells Fargo, B of A, or Chase has with the Fed. So the way I see it, that would create an additional $1 trillion circulating in the real economy, but yet bank credit expansion would have been flat. Am I understanding that correctly?
Yes, so that is a separate mechanism to the one I mentioned earlier.
Okay.
That's right. That's also possible. And in fact, that is, I think the reason why this is encouraged has partly to do with these CBDCs, because increasingly what we see is, you know, the central bank stepping out and becoming like a normal bank that's dealing with the public.
Right.
This is really what's happening. And of course, when you have the bank regulator that can easily make life difficult for banks, obviously, and they have been over the last decade or so, becomes a bank, a player competing against the others. You know, that's not a level playing field. What's going to happen is the banks will start to disappear. They'll be forced to merge. And of course, this has happened in the last 15 years already because of increased regulatory pressures and burdens and costs. And on the other hand, also the interest rate policies, you know, zero and negative interest rate policies, as the ECB has been pursuing, are killing banks. Right. So they are forced to merge because traditional bank lending, you know, with a flat yield curve on an inverted yield curve just doesn't make sense. Only the speculative lending then makes sense.
Yeah, right.
And so you get fewer banks, and you know, banks are dying. And this is what's happened in the US and the Eurozone. In the Eurozone, since the ECB started business, 5,000 banks have disappeared. Yeah, and a similar figure in the US.
And if they go back to a central bank digital currency where Jerome Powell can issue auto loans and mortgages, let's say, how do you compete? How do you compete with a bank that, to your earlier point, can have negative equity?
Well, exactly. You can't.
Yeah, so
you can't compete. So really, what we're heading for is the Soviet system. Yeah. The Soviet Union had, certainly during a key period in its history, had only one bank. Gosbank.
Stalinist. I want to be clear. Stalinist Russia. I've heard you talk about this, and this is actually where I wanted to take the conversation next.
That's right. Under Stalinism, because you know, Stalinism is about total control and centralized totalitarian power and control over people. In that system, what you want to have is just one central bank that controls all financial, transactions essentially. And of course, in those days, I mean, Joe Stalin had very crude methods available to him. Nowadays, it's much more fun to be a totalitarian dictator, because you can actually use high tech to fine tune your dictatorship.
Right.
And with central bank digital currency, it's not really money, it's not really a currency, it's a control tool. You can switch it on and off completely selectively, not just by person, but also by the type of shopping they're doing. And maybe this product is okay, but not that product. Will be tailored to you for your benefit, probably using AI or maybe something else. But it will all happen. That's the trouble. And that's why, we need to be very much aware of these developments and try to stop them.
Yeah, I think because the central banks can have negative equity, therefore they can loan to people based on anything they want. They don't necessarily have to consider their credit worthiness. I'm concerned that in the future, we'll see most of the lending being based on a social score instead of a credit score. Do you have any thoughts on that?
Well, yes. I mean, that's the system that we have to some extent in China in some version. Companies in particular being evaluated in this way in China. And I suppose, the controllers and central planners in Europe and America have been very jealous of China. And so, they look there and say, oh, we wish we could do this. Well, how can we engineer for this to be done here too? And so, that's what they'd love to introduce. But all of these things should be done out in the open. They should be discussed. There should be democratic debates and then votes on this. Like, is this what we want? I mean, do we want a Stalinist system? Yes or no? Let's have a vote on it. But that's not happening. And that's the devious thing, the sinister thing.
And does the centralizing go one step further with a digital SDR? Because I've listened to the IMF and the World Economic Forum and how they're pushing for the SDR to have to be the global reserve asset on central banks' balance sheets instead of gold or dollars or something else. So now you're dealing with at least with the central bank digital currency, you've got competing central banks. But if you go to that system, then there's just one group and they're not elected. So how do you see that?
Well, I think it's the natural corollary. Once you agree to central bank digital currencies, then it's a small step to say, well, let's link them all up in some way.
Yeah.
And then, SDR would be one way to do that. They could call it something else, or, or use the BIS instead of the IMF. It almost doesn't matter. It's just a natural step that follows once you agree to this totalitarian control with central bank current accounts that are called CBDC.